And there we are. Hello
Hello
everyone. We're a little bit delayed today because we had a surprise addition with Sanjay joining us. So we've got all four of us here for a change, which is nice. How Tom, Adam, how's your week's been?
Really good, really busy, and by the sounds of it, same as you guys as well. So can't complain. Yeah, really good. David?
Exactly that. Yeah, really busy. Lots of phone calls, lots of customers, which is good news for us. I seem to be seeing you guys everywhere on social media with a new property every day as well. So I think you guys must be the same, right?
Yes, absolutely. And we love it.
We do. There's a slight delay on Sanjay's feed, but that's fine.
That was very impressive then. You managed to speak without moving your lips. It was incredible.
There we go. Man of many talents.
We've caught up now as well. Well, it is the second Friday of the month. We've lost Sanjay again. I think he'll just be in and out for the duration of this. So Money Talks, once again, we're streaming live across multiple platforms. So if you can hear us, give us a like, just let us know you're there. Any questions you've got, find them in the comments. We will be taking questions live. If you're watching later as well, just fire away. Let us know what you think. Any opinions are always welcome, good, bad, or indifferent. So first topic of discussion is rates. We always talk about rates. Are they going down? Are they going up? I did a live the other day where we all had a sneaky little suspicion that the base rate was going to go up, but lo and behold, we are still where we are. What's happening, Tom?
So I think this is maybe the fifth one we've done of these, I want to say, and I think the last four, it's been very much comprehensive that rates were going down every single one of these that we've done before. And I think this is the first one where we can safely say that rates are higher than where they were last month. There was a lot of speculation about the Bank of England base rate increasing. Obviously, as I spoke to you about just before your Facebook Live, that didn't end up happening. But the sort of crazy cheap rates seem to have ended. I did a little bit of looking at the start of the month, and there were 131 mortgage deals below 1%, which is crazy.
131 deals below 1%.
And last week, when I looked, there were 30.
Wow.
So less than a quarter of the sub 1% deals available. You know, I did an application in October for a 5% for a 5-year fix at under 1%, which is almost unheard of. And I think it was sort of July or September they started coming into the market at 5-year fixed rates under 1%. A few lenders started offering them July, August, September, and now it's not a thing. So crazy.
So fewer and fewer are actually offering that. Interesting. Chris Gray has just said hello. We all gave him a little wave. I think he means, when do you think the rates will actually go up? Quite ironic from the older grammar king there, but
I think with this amount of speculation, it's definitely a case of when rather than if.
Yeah.
And I think it's going to be in the very, very near future. I'd imagine that there's clearly something that's driving all the speculation, and December, January, February, it certainly wouldn't be surprising if we saw a Bank of England base rate increase in one of those months.
Yeah, the Bank of England's been relatively open in the fact that they want to get the base rate back up to where it was before, which is up at 1%. But the plan is that's going to be done tapered over the next 12 months. I incorrectly called between us that it was going to go up in November, and I was wrong. So never mind. But the reality is with mortgage interest rates, we've seen the people with bigger deposits be affected the most. So if you had a 40% deposit, like Tom's alluding to, where you had those sub 1% deals, those are where you've seen the rates increase. What you've seen happen with the higher loan to value, so people with your 10% deposits, rates are still actually going down every now and again with some lenders, or also staying the same. So they don't seem to have been affected quite as much yet. It's the lower LTVs with the higher deposits for customers where they're going up, where banks are basically pricing in an increase at some point.
That's where the margin is, though, isn't it? Those higher loan to value deals, that's where the margin is for the bank. So they're really, really competing for that business, because clearly they're going to make a lot more money on a 2.5% mortgage than they are on a 1% mortgage. So that space at higher loan to values is where we see a lot of competition for that business between the major lenders.
So what's your advice for people at the moment to make sure that they're going to get the best deal and lock it in for the longest time?
Well, as I think what we said before, as long as it ties in with your plans for the future, then taking a 5-year fixed rate is always a good thing to do whilst rates are this low. Admittedly, I've been saying it for the last 10.5 years, but rates can't be this low forever. They do have to increase at some point soon. So it's a really good time to look at longer term fixed rates, and even if they're going to be a little bit more than what a short term fixed rate could be, just think about the impact if you took a shorter term deal and then rates were 1 or 2% higher in 2 years' time when you came to remortgage. What sort of position would that leave you in? So it's definitely a good time to weigh up options and look at all the pros and cons between 2 and 5.
The advice is still relatively similar to conversations you're having, because interest rates are relative, right? They're going to go up, they're going to go down, they're going to fluctuate over time. And your advice is always going to be to a customer, what's your situation, what's your plans? And it's going to be specific to the wants and needs of that person and what they're looking to do over the next 5-10 years, whatever it might be.
Yeah.
So I had an interesting conversation. Can everyone hear me okay, by the way?
So much better.
I mean, we are live, Also, just on a complete side note, we're colour coding Ellen and myself, and then Tom and Adam. Oh, look at that.
Brilliant.
I hear, actually, you missed this before you joined, Sanjay. There may well be some partners hoodies.
There are making debut appearances next week. So if that's not a showstopper, I don't know what will be. But
we can finally update that cover picture of you three in your 3-piece suit. So
yeah,
maybe you'll get most of my head on it as well. I seem to be missing an eye on the picture. Yeah. I didn't take it personally. It's fine.
Right. So big,
as you were saying,
the big question, which I'm always getting asked. Yesterday afternoon, I was sat in someone's living room, and they were saying to me, 40 years ago, when they were taking out a mortgage. This is probably before we were all born, I think. I'm not going to say any names. But yeah, they were paying 17% interest rates. Madness, right? But the big question now is, and this is the conversation I'm having with sellers, and if you're a seller or a buyer watching this, we would love your input. Next year, if interest rates do start creeping up, will the house prices start to flatten? Will they start to decline because borrowing is becoming slightly more expensive? I mean, the reality is it's still very, very cheap, but will this bubble we are in at the moment, what me and Ellen are facing, and obviously you guys with the mortgage applications, will it carry on? That's the big question that everyone wants to know.
I think it's quite similar to what me and Tom and Adam were talking about just before we went on, actually. We've got quite a few first-time buyers looking at these 1 and 2 bedroom houses that are going like 10-12% over the asking price, and you're talking about 8, 9, 10,000. But for them at the moment, they're looking at it of, well, what's an extra 10 grand over the next 35-40 years, in terms of a monthly payment. It doesn't make that much of a difference to them now. But if you're looking at 15% interest rates, that's ginormous.
I've been asked a similar question a couple of times only in the last couple of weeks as well, when people were thinking again about mortgage interest rates and long-term plans and what they should do. And look, no one's got a crystal ball, but as long as there's an availability of mortgage funds, it's normally going to be okay. If we hit 16-17%, I've got no idea what's going to happen, because that's just, I've never experienced that myself. But I think I always go back to when I get asked the property price question, it's supply and demand, and the figures are 16 buyers for every 1 seller. We've got a housing shortage in the country. We've got stock issues in terms of coming to market and people selling properties. As long as you've got more buyers to that ratio than you've got sellers, house prices will continue to increase. That's that's the way the market works, isn't it? And then there's that old adage, location.
No, 100%. I think one of the things which you're talking about buyers, I'm probably going to make a video about this later. Don't worry, Ellen, it's not going to be a rant video. It's just going to be a video. But, I feel really, really sorry for buyers at the moment, because especially if they're looking in that mid-range market, and I want your guys' opinion on this, because when I speak to buyers, they're offering on properties an over asking price offer, and they're still not getting it. And this is first time buyers and buyers that are nothing to sell and rented, not even in the ones in chains. And then they're saying to me, well, look, I'm going to go back to my mortgage broker and see if I can get more money. Have you had a lot of that recently? And would you advise that? I know it's down to personal situations, but what are your thoughts on that?
So I was talking to Ellen before we came on, actually. I'm actually dealing with a first-time buyer at the moment, and he's offered over asking price on 3 different properties now and missed out on all of them, which is an absolutely crazy place to be. But I think that there's definitely, I would be very, very surprised if for the majority of people, a second opinion doesn't open up more avenues that they maybe haven't explored before. So as much as we all like to admit that we're perfect, mortgage brokers do tend to overlook things from time to time. And there can be situations where a different point of attack or a different lender or a different avenue might open up another 10, 15, 20 grand of borrowing that maybe was impossible before. It's very much not a gospel that once you've been told what your maximum is, that's absolutely definitely the maximum you can go up to. There will often be different lenders to look at or different avenues to explore that could mean that you can get up from 280 to 300 or 300 to 315, which is going to be the difference maker in, like you say, a crazy market where properties are going over and above the asking price.
Just to jump on the back of that, again, regular contact with your broker or a second broker, whatever, is a good thing to do, because not only your situation might stay exactly the same, but the market and the lender criteria changes. So I've only spoke to a client this morning who I did an agreement in principle for, and when we first spoke 3 weeks ago, they could borrow X amount with Halifax. And then when I spoke to them and did their agreement in principle yesterday, they can borrow more. Their situation's identical, but Halifax have loosened how much they're prepared to lend at that loan to value. So that regular contact, and going back to what we've said on these before, don't underestimate preparation. So making sure you've got your agreements in principle, making sure you've got your documents, put yourself in the position of the seller and the selling agent, and make sure that you're presenting your offer as best as you possibly can.
So would you advise, let's say, for example, Ellen and I have got an open house tomorrow in a 3-bedroom house in Bracknell, got a lot of interest, lots of viewings, pretty much a full diary. Would you advise, as a buyer, and if a buyer came to me and said, look, Sanjay, I've just seen this property you're marketing online. I'm really interested in it. I've done my homework. I've driven past the property. I've spoken to my broker a week ago, and then I've spoken to them this morning, and they actually said, yeah, I can afford probably over the asking price. Would you advise your clients to speak to you before going to view a property which they're very, very interested in? And I'm saying this because of the market we're in.
Every time.
100%. 100%.
Because that will be the difference between them getting the property and not getting the property. Because if they're under the illusion, if the property's on for 400 and they can only get 385, but they haven't spoken to you in 3 days or 24 hours, something could change, right? And they could potentially offer more.
So let's face it, when you got this open house on Saturday, it will probably be sold by Sunday evening. Let's face it, you're going to get offers over the weekend, it will be sold by Sunday evening. If someone doesn't know absolutely what their maximum is and views the house on Saturday, really, really likes it, and says, right, guys, I need to check my figures before making an offer, they send an email or a text to their mortgage broker, and their mortgage broker picks it up Monday morning or Monday lunchtime, whenever it be. It's too late. Property's gone. They missed the boat. You need to, we've never seen a market like this where you need to be so prepared and almost over prepared, so you're just not missing out, because like you said, it'll be gone by Sunday evening.
Exactly. That's a very good point, and this is a plug to you guys as well, because you guys are available pretty much 24/7 like we are. And it's very helpful for us, because especially like Ellen tomorrow, like what's going on tomorrow, like potentially how many offers can you get, and how important is it to have these guys on side and available? Absolutely.
Yeah, no, we've got pushing 20, I think. And I'd expect 3-4 offers out of that, and to have these guys on hand to just pick up the phone, get them qualified, and make sure that the advice they've been given already is correct, and that it's up to date, and then it really comes down to everyone on their individual merit, and how you guys are all about
changing agency for the better and making a difference, etc. And I think it's the same for us in that for both of us, Monday to Friday, 9 to 5 is just outdated. People need a fast response, and when people ask you a question, they expect an answer yesterday. So if we're available Saturday, Sunday to do these things and to put people in the best possible position, all of our clients have our WhatsApp, same as you guys, and I get texts on the Sunday 8 p.m. reply. It's just all part of it.
I said to a client earlier, the other day, I said, if you can order an Amazon package and get it delivered before I can reply to your email, I think that's a problem.
Big problem. That's so true. I love that. I'm going to use that.
I'm going to take that. Yeah, the way I look at it is people like the general public who are buying or moving house, that's not their job. They all have other jobs to do, 9 to 5 in general. And they need to deal with the moving stuff outside of those hours. So to expect them to deal with it during their own working day, I think is just so backwards. So.
Let's flip this round to sellers, because obviously this is where Ellen and I come in. And I'm going to plug, but how we operate is that we give the seller feedback straight away. And the worst thing, and I speak to sellers all the time, they absolutely hate it, especially if they've got an open house on a Saturday. They have to wait till Monday morning. And let's flip this back to a buyer's situation. When a buyer's like, well, they want to offer on the Saturday afternoon, they want to hear feedback straight away. The seller wants to know feedback straight away. So if you are that buyer, if you've got that mortgage broker to speak to put that offer forward within 2 hours, 3 hours, I'm not being funny, but you're right at the top of the queue. You're right at the top of the pecking order. It shows the commitment levels. It shows the attachment to the home and how much you want that home. And, from an advice perspective, that's so important when you're offering.
So I say to almost everyone, like the thing that you can do to make yourself stand out for the crowd is make yourself as an attractive proposition as possible to the estate agent. So if you can be really forthcoming with all of your information and you've got all your ducks lined up already, like you say, the estate agent's going to do everything they can for you because they know how easy you're going to work with from now right until you move in. So getting all your ducks lined up and being super prepared is super important.
Yeah, like it.
Totally agree. Okay, so back on to sort of lending criteria and things. And for anyone that's just tuning in now, put in any questions that you've got live for Tom and Adam, or even myself and Sanjay to answer. If you're watching later, we will read those questions and follow up as well. So 5.5 times income lending. Mm-hmm. Who's that available for, and what are those? Tell us all.
So in general, high earners. So as a rule of thumb, most lenders want over 100k of household income. There are a couple that will look at over 75, but most want over 100. And most would like a lower loan to value, so under 75%. So the sweet spot in general is over 100k household income and under 75% loan to value. There's a little bit of an outlier. HSBC will do 5.5 times income, household income over 100k, all the way up to 90% loan to value.
So if you put that into kind of tangible terms of what deposit level versus what value of house kind of thing.
Yeah, so 10% deposit.
Yeah. So,
if you're looking for a house at 600, 10% deposit is 60,000. So a mortgage of 540, 100,000 pounds of income, times that by 5.5 will get you up to that mortgage size. When historically it's been maximum 5 times, if not 4.5 or 4.75. So it's really good to see lenders return to a good amount of income multiples for high earners, because in general, those higher earners have more disposable income. So you can put that towards being able to afford a higher. That's the train of thought.
Interesting. Okay. And you mentioned something, Tom, the other day, that you're seeing service levels from lenders starting to slip. What is that about?
So I think it's just not just mortgage companies, but every company in this country now, they still seem to be able to get away with using COVID as an excuse for poor service. So when we ring through to lenders for mortgage updates, almost every single lender at the first time you pick up the phone, you have an automated message to say, our service is slow because of COVID-19, blah, 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 blah. It does seem to just be a volume of applications, but same as always, there are lenders that are good and there are lenders that are bad. And again, it links back to the previous point we made, that if you're buying a house and the estate agent or the seller is expecting quick mortgage process, and you're choosing a lender that's going to take 17 working days to look at your application for when it gets submitted, that estate agent or that seller is going to get cold feet when 3 weeks in, they're asking for an update and you've got to go, I don't know, I haven't even looked at yet. So again, with service levels slipping with a lot of major lenders, and again, with a lot of major lenders, it's good. With a lot of major lenders, it's unfortunately bad. It's not always about who's going to have the best deal. It's going to be about who's going to actually be able to turn this around quickly for me so I can make sure that I keep my purchase together.
Yeah, again, just to jump on that, I think there's distinctions, isn't there? If you're doing a remortgage and you're just refinancing your current deal and it's due in 3 months, time you've got plenty of. You can look for exactly the best deal, and if it doesn't take 2 weeks to get your documents assessed, doesn't really matter because you factor that into the time. But a conversation we always have with a buyer or anybody that's going to be selling and buying is you need to think about the transaction and keeping it all together, because it's no good going for absolutely the best interest rate if after 3 weeks the survey's not been booked in and the seller decides they're going to sell to somebody else because they had 4 offers on that Saturday, and they just go back to the people that were maybe a bit more motivated and offering a similar amount. So it is about keeping up to date with timeframes of lenders and who you can get a fast offer for and keeping everything happy.
So lenders that take, let's say lender X, so we won't drag anyone's name through the mud, but let's say lender X takes 3 weeks to assess documents and information. You submit the mortgage application, you submit your pay slips and bank statements. They come back to you in 3 weeks' time and query some transactions on the bank statements. You answer the questions, it goes to the back of the queue for another 3 weeks. They raise some more questions, another 3 weeks. So suddenly you're at 9 weeks in, and it's not really unheard of for mortgage lenders to query a couple of transactions or have some questions in regards to the pay slips or the statements. And 9 weeks, let's face it, you'll have probably lost the property by then.
It's a long time. That's a long time for that process.
Absolutely. So your service factors a lot into our advice in selecting the right lender, because it's not always about the best rate if the purchase potentially can be put in jeopardy by
You're
service.
so right about the automated message as well. But are you calling this, solicitor at 8:30 when they open and they say we're experiencing a high volume of calls at the moment? You just think you've only just opened the phone line. It's not true. But yeah,
it's just an easy excuse, isn't it? COVID is just an easy excuse for sorry, we're not very good.
Wow, don't mince your words there, Tom. Fine. And the other thing that we said we talk about is let to buy. People who are keeping their house, buying onwards and converting their current mortgage into a buy to let. So effectively letting to buy the new house. Is there some new rules that have come out on that for people?
There are, and this is something I want to pick up on, just because it is quite high level and quite complicated, but hopefully it will be useful for some people. This is something that we used to do a lot of before the stamp duty changes. So when the stamp, and I don't mean the current or the ex-current holiday, I think it was March 2017, I believe it was, when the 3% surcharge was introduced for additional properties. And unfortunately, that hit people that were looking to do a let to buy. And what we mean by let to buy is moving without selling your current home, so letting it out rather than selling. We used to do a lot of those, and they sort of dropped off a cliff in the amount of people doing it when those rules came in, because it was just an additional 3% stamp duty to pay, which is a crazy amount of money usually, especially around this area. So in general, mortgage lenders will ignore the potential rent you'll get from your current property and also ignore the mortgage payments. They'll sort of cancel each other out. So if you're going to be taking a buy-to-let mortgage on your current home that's maybe £400 a month, and you get £1,000 a month in rent, I'll say, right, we'll cancel each other out and we'll just base our affordability purely off of your earned income, employed income. HSBC introduced a change maybe about 4 weeks ago now, where they will now take the rent from your current property almost as part of a top up to your employed income. So I'll try and explain as best I can. Let's say you earn £50,000 a year and you could get a 5 times income multiple. So on your new house, you could borrow 250,000. If you had a property that you're looking to do a let to buy with that was going to generate £1,000 a month in rent, they could take up to 100% of that income to be used towards your affordability. So £1,000 a month, £12,000 a year in rent, added to your income of 50,000, you could potentially now borrow 315,000 for a mortgage rather than 250. So £65,000 more. £60,000 more, because we're taking that rent on top of your current salary. So massive, massive changes for let to buy. And historically, we've always found that let to buys are a little bit tricky to place because of the affordability and 2 mortgages, etc. But having that could be a real game changer, to be completely honest.
Is it still minimum 25% equity they need to have in their home?
Generally, yes. You can get away sometimes with 20%, but 99 times out of 100, you'll need 25%. So what we'll find normally is, people will have, let's say, 50% equity in their homes. Rather than selling, they'll release some equity to go towards the deposit of the new home. So if they had 50% equity, they could maybe release 25% to take them up to 75% loan to value on their current property, and then use that for their deposit for their onward purchase.
Yeah, nice.
So really, 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 really good changes. So it's nice to see things over the last few months, real positive changes, whereas in the last maybe 12 to 18 months, lenders have been making negative changes, getting a bit more cautious about what they're doing. Whereas over certainly the last 2 to 3 months, we've seen a lot more positive changes, which is really good.
I think what we'll see, and we've said this before, is where rates become less of a space to be able to compete in, because they're pretty much one and the same depending which lender you go to. It means lenders then have to resort to changing criteria and being flexible on what they'll allow people to do or how much they'll lend in terms of multiples, what they won't deduct on pay slips and things like that. So it starts to be very much less about rate hunting and more about specific criteria.
So a couple of very happy chappies with that news, that's for sure.
I've got a completion, so I might need to go in a bit.
How exciting.
Congratulations
to buyers and sellers.
Good. Okay. Well, I mean, we're approaching the 28-minute mark anyway. If, like me, when Tom spits out all those numbers, they don't quite go in straight away, I'm sure he will be happy to take some time, break it down and explain it to you if it can benefit you and help you get moving. We do these lives every second Friday of every month at 1 o'clock. So money talks, anything you want to know about mortgage market to help you move, to help you remortgage, or any questions that you've got, fire away. We're here every month. So anything else to add from you, Sanjay, before you dash off and make some people very happy? That sounds terrible.
That does sound terrible. Absolutely. Yeah, no, nothing from me. Thank you for coming on, guys. Appreciate it.
Thanks for having us, and nice to see you, Sanjay, on one of these. And next month it will be partners hoodies and Santa hats as a standard attire.
How exciting. Okay. Great. All right. Well, we'll look forward to catching up again this time in 4 weeks' time.
Thanks, Ellen. Thanks, Sanjay.
Good to see you guys.
Bye.